This is Macro Horizons, episode 313, Entering March and Madness, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of March 3rd. And with the official beginning of spring in sight, we've stepped outside, seen our shadow, and predict 6 more weeks until tax day. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the Treasury market got several key inputs that helped drive a rally that saw 10-year yields get below 4.25. One of the major themes has been that the February economic data, the post-Trump 2.0 re-entering the White House, has been erring on the side of a bit softer from the consumer confidence side. So we've seen that both from the Conference Board data, but we also saw that on the business side from services PMI in the prior week. This has occurred at a moment where equity market underperformance has become thematic, with the S&P 500 dipping below zero for year-to-date performance. Let us not forget that we also saw an, as expected, 0.3% increase in core PCE. This was largely in line with expectations. However, Friday's data set contained an interesting surprise in the downside for personal spending, which decreased by 0.2% in nominal terms, as opposed to an anticipated 0.2% gain. Perhaps more importantly, when translating this into real terms, we saw real personal spending down 0.5%. Now, as this represents January's data, this does not set up Q1 to be a particularly strong quarter for growth. That being said, the growth profile in 2024 suggests there's plenty of momentum to be brought into the new year. And more importantly, it is just one data point, so we'll be eager to see how the consumption figures play out over the course of the quarter. Taking a step back, when we think about what had been driving growth, the consumer had been strong, although we're now starting to see some signs of that strength waning. We also saw government spending a key contributor to growth over the course of the last couple of years, and clearly, with DOGE now in focus, there's downside, not upside risk to government spending driving growth going forward. And the final two wild cards come in the form of fixed investment, i.e. the housing market, which, when faced with higher mortgage rates, we struggle to see accelerating in any dramatic way, at least not over the course of the next couple quarters. And then there's the contribution from net exports, which, in light of what has occurred on the trade war front, we struggle to see any upward momentum on exports. So as we move into 2025, the headwinds for growth are gaining in relevance and arguably magnitude. We also saw an unexpected increase in initial jobless claims to 242,000, which, while it was not NFP survey week, suggests that the broader sentiment and momentum in the labor market might also be waning, all of which contributed to lower yields and a bond bullish environment. We'll note that for the first time in a few weeks, we have seen the 2-year sector dip well below effective Fed funds once again, pushing toward 4%. While we've yet to realize 3 handles across the curve, we are still constructive on the Treasury market, with a nod to the fact that the 2s-10s curve appears to be anchored at roughly 20 basis points, and the cyclical re-steepening in the curve that we've been looking for is continuing to struggle to materialize, although we do take some solace from the fact that 2s-10s are in positive territory.
Before January's core PCE report, it was really a week that didn't hold a great deal of new fundamental information. We had 2s, 5s, and 7-year auctions that were all met with remarkably strong demand, in a testament to the building narrative that's playing out in the rates market. And more importantly, from our perspective, was the price action itself and the fact that even without any really top-tier new economic information, there was no payrolls report, there was no CPI report, there was no Fed meeting, we still saw 10-year yields drop to their lowest level since early December of last year, well through the 4.25 level we had been tracking. And if the buying interest we're seeing in U.S. rates is any indication, there's a growing sentiment that the policy uncertainty out of Washington and the fact that monetary policy is still in restrictive territory is creating a macro backdrop that leaves a reasonable amount of appeal for rates at these levels, which in any historical context during the pre-COVID period are still remarkably high. Before the pandemic, 4.25 10-year yields would have been one remarkable buying opportunity.
And in fact, as we watched the front end of the market improve as well, we saw 2-year yields almost reach 4%, and the 2s-10s curve appears to be anchored at roughly 20 basis points. Taking a step back, since the middle of January, the 10-year sector has rallied more than 55 basis points, as the market has come to grips with the balance of risks associated with the changes coming out of Washington, D.C. We'll be the first to concede that one of the more surprising aspects of the price action and the broader macro narrative has been the focus on government efficiency and what that means for payrolls in Washington, as well as any potential contagion to the broader labor market. That has become very topical, especially in light of the increase in jobless claims, which came in at 242,000, marking the highest weekly print since early December. This creates an interesting backdrop as we look forward into the balance of 2025 and consider how long the Goldilocks economy might be the operating narrative. And of course, this brings back into focus the Fed's dual mandate, or at least the employment aspect of the Fed's dual mandate. And it's notable that sentiment regarding the resumption of Fed normalization has certainly shifted. The market is now pricing in more than 60 basis points worth of rate cuts in 2025, despite calls that the Fed might need to be on hold for the balance of the year. We remain on board with the notion that the Fed will eventually resume normalization. Perhaps the first rate cut doesn't come until September, but we still see the path of least resistance being 50 basis points of cuts this year, followed by an ongoing effort to normalize in 2026. Now, as we contemplate how that translates into the outright level of yields, we expect that this will limit the extent to which the long end can back up in yields, 10s and 30 in particular, before buying interest becomes relevant. Now, the recent price action suggests that the lower bound for 10-year yields this year will have a 3 handle, if for no other reason than how easily 10-year yields managed to get back below 4.25 in the first quarter. One of the renewed concerns that we've been contemplating is what happens in the event that the employment market continues to deteriorate and Trump's trade war translates through to higher realized headline and even core inflation. This would be a version of stagflation, with the external shock from tariffs translating through to higher consumer prices while confidence in the employment landscape deteriorates. Certainly, a late cycle spike in the unemployment rate wouldn't be atypical, given everything that we've seen over the course of the last 2 years. However, the truly complicating factor would be what happens if that occurs with headline CPI accelerating instead of moderating.
And that gets to what was one of the most important dynamics of the early part of the tightening cycle, which was the implicit question of which side of the dual mandate was more important to the Fed. At that time, it was the credibility as an inflation fighter and the restoration of the faith in the central bank to bring inflation back under control that was the clear point of emphasis. And even if that risked a more dramatic turn in the labor market or even a recession, that was a price that Powell was willing to pay in order to prevent an inflationary spiral. However, it's worth considering that at that time, labor demand was still in the process of surging coming out of COVID. The overall backdrop of demand for workers was still high enough that even the massive amount of tightening experienced in a very short amount of time wasn't enough to derail what is still a very solid jobs market. However, looking forward, that trade-off is less clear-cut. Obviously, the unemployment rate has moved higher, labor demand has cooled materially, as has wage growth, and while there's been meaningful progress in bringing core inflation back closer to 2%, it's that trajectory dynamic and the risk of a reacceleration of inflation that puts the Fed back in a precarious position of potentially needing to risk a lower or even potentially negative growth outcome because prices are moving higher as a result of policies out of Washington. This is to say nothing of the direct impact that potential government layoffs will have on the labor market directly, along with the political pressure that is sure to fall on the Fed in the event we start to see the economy turn more dramatically. During the first Trump administration, Powell was no stranger to criticisms from the president, and especially if we start to see that Goldilocks narrative you touched on come into question, Ian, the Fed is going to once again find itself in a very tricky spot.
And as a harbinger of the shift in sentiment, we've been watching the equity market performance over the course of the last several weeks. It's notable that the S&P 500 is now negative year to date, which implies that the optimism associated with Trump 2.0 has faded as the market looks forward to what is an increasingly challenging both geopolitical as well as global trade environment. The fallout from tariffs will be uncertain, and while we have focused a fair amount on the implications for realized inflation, there will also be a profit compression and growth component. If we reflect on the 2018 round of tariffs, what we saw was a limited pass-through to end-user prices and more of a hit to corporate profitability. Now, the refocus on tariffs comes at a particularly inopportune time for the equity market, where profit erosion has already become topical, and equity valuations are clearly coming into question. Now, when we view this through the lens of monetary policymakers, a steady but measured decline in equity prices will translate through to tighter financial conditions and presumably help contain forward inflation expectations. The risk, as is often the case, is that the move takes on a momentum of its own and ends up being extended to the downside, which would then bring into question the Fed's ability to delay re-engaging in normalization. It's not difficult to envision the magnitude of a downtrade in the equity market that would get the Fed re-engaged in conversations about cutting rates. However, for the time being, we suspect that the Fed will be content to look past a 5 or 10% correction in equities, just as long as the move doesn't materially spike realized vol and thereby unduly tighten financial conditions.
But critically, as we've made our way through February, what the wobbles in risk assets do cement is the fact that the rumblings and early conversations around the potential for the Fed to give up its easing bias were probably a bit premature. Of course, a relatively orderly 5 or 10% drawdown in the equity market is not going to be enough in and of itself to prompt a dovish response from the FOMC, but what grinding lower, or at least not perpetually rallying, equities means is that the tightening implications for financial conditions take some of the urgency off the Fed to sound unduly hawkish, continue to push out rate cuts, or even introduce the potential for a rate hike. And what this all will do, to get back to the level of yields and what we've seen in terms of investor behavior, is keep that dip buying bias in treasuries intact. Obviously, the outright level of rates are still high enough to bring in demand. We have all the uncertainty associated with the new presidential administration and the longer-term trajectory of the economy that's been playing out over the course of the last year or so, to say nothing of the fact that other central banks continue to move their own policy rates lower. That all points to a global trajectory of yields that is heading down, not up.
Returning to the equity market briefly, it strikes us that while we've spent a fair amount of time over the course of the last several years talking about the notion that there's a Fed or a Powell put in the market, Trump's apparent sensitivity to the performance of financial markets in the U.S. suggests that there might also be a Trump put in the equity market. In practical terms, it will be very interesting to see over the course of the next several weeks or months how the president responds to any material downturn in the equity market. Is he willing to shift his stance on the global trade war, or will he be content to let valuations readjust to lower levels? If nothing else, it will be an interesting period for investors in both equities and treasuries.
And we touched on it earlier in assessing the strength of the rally that took Treasuries to their latest highs this week. But we would be remiss not to revisit the fact that despite auction sizes that still remain lofty, even if they're probably not growing until November at the earliest, and the fact that rates were at effectively the low yield marks of the day for 2s, 5s, and 7s this week, we saw roughly a basis point stop through at each of those three auctions, and in the case of 2s, it was the highest end user allocation on record. Made all the more notable that 2s are not especially attractive either in outright terms and on the curve at the time, but clearly the buyers of treasuries in both the primary and secondary market came out this week in full force and now have effectively undone all of December and January's reflationary angst-induced sell-off, with 10-year yields at 4.8 now feeling like an increasingly distant memory.
So essentially what you're saying is that the more rates change, the more they stay the same.
No, it's more like 4.8. Thanks for the memories.
In the week ahead, the Treasury market's biggest influence on the data front will come from Friday's release of non-farm payrolls. Here we have the consensus for an increase of 158,000 jobs, with the unemployment rate coming in at 4.0%, or unchanged on the month. Given all the uncertainty related to hiring or firing in Washington, we'll be watching for the contribution from the government sector and where that leaves private payrolls when all the proverbial dust settles. We'll also see the typical pre-payrolls job proxies in the form of ADP on Wednesday, the Challenger figures on Thursday, and the ISM services for February, which we'll see on Wednesday morning. Recall that the downside surprise in services PMI was a key contributor to the recent rally, and so the market will surely be focused on the trajectory of ISM services, which is expected to come in at 53.0. We also have ISM manufacturing on Monday, which is seen coming in slightly above the 50 mark at 50.5. Now, financial markets more broadly will have to contend with what is expected to be the implementation of new tariffs on Canadian, U.S., as well as Chinese goods on Tuesday, March 4th. The performance of risk assets recently suggests that investors are growing increasingly nervous about the implications from the trade war and what that might mean for the direction of global growth. Indirectly, that would feed back into an absence of demand-driven inflationary pressures, which should put some downward pressure on break-evens. We're certainly cognizant that forward inflation expectations remain elevated, particularly when we look at the survey-based measures. Now, to a large extent, this is consistent with the implications from an increase in tariffs and what that implies for goods inflation going forward. Of course, the flip side is that as prices get higher and consumers become less confident about their job security, as evidenced by a relatively low quits rate, consumption patterns could come under pressure, and as we reflect on the negative 0.5% real personal spending figures in January, we cannot help but be increasingly nervous about the trajectory of real growth as Q1 gets underway. The week ahead also contains a variety of Fed speakers, including Williams, who speaks twice, both on Tuesday and Friday, and as he's the head of the New York Fed and considered to be one of the core decision makers on the FOMC, we'll be eager to hear any nuance that Williams might offer on the end of QT and the potential triggers for the Fed to resume the process of normalization. We have reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And with the February employment report on the horizon, we're reminded to never count your payrolls till the doujin's done. Should have been a saying. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/macrohorizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.